Coming up on today's show, non-farms beat expectations, but the unemployment rate rises. White girl stocks are back. Is sentiment getting too bullish? And what to expect in the week ahead? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks rose mostly on Friday. We notched gains for the week as investors took the latest monthly jobs report as a sign that the Fed will likely cut interest rates. Guys, there is a official 90% chance after the jobs report that the Fed will cut by 25 basis points at the December 18th FOMC meeting. And the big names led the rally like it has for most of this week. We really saw the mega caps outperform, led by Tesla, Amazon, and Meta. Google gained, Microsoft 2, Apple was flat, and Nvidia lost 2%, but the semi-space was held up by AVGO, up 5.07% today, and software was fairly green, slightly mixed. All in all, great for tech, great for the mega caps, but stuff like industrials, real estate, utilities, energy, highly cyclical and defensive sectors took it on the chin. And financials, again, very mixed day, except in credit services, which was very, very bullish. PayPal was up 1%, MasterCard up 0.72%, American Express up 1.7%, and JP Morgan as well, up 0.79%. All in all, a very bullish day across the board, particularly in the mega cap space and technology space. You could see the XLY discretionary, consumer communication services and technology were all green today. That led the SPY to be up 0.22%. Financials were largely flat, and then every other sector lost, with the worst sectors being energy, utilities, healthcare, and staples, down quite significantly here on the day. And this is what we really saw for the week. It really just was a week of buying the mega cap names, buying the Nasdaq 100, and they were really the outperformers this week. And looking at the broader market, it was growth as a whole that really outperformed. Today, mid cap growth shone, but this week it really was just large cap growth that really did outshine the rest of the market. But we saw gains here in small cap growth, large cap growth, as well as large cap core. And then we saw declines in the value component of the market. So again, we really are just seeing this rotation underneath the hood happening. Last week, we saw value outperform, blend outperform, large caps being put to the wayside. And this week, we saw the growth names gain momentum. But breadth continues to deteriorate, something we have seen so far in the market this week. Not a bad thing overall, but for this week, we only saw stuff like 34% of stocks advancing today, and roughly that's what we saw for the week, 65% declining, 1% unchanged. But when you look at everything in aggregate, excluding the 5-day, which tends to be very, very noisy, the longer term moving averages are very, very robust, and you just want to buy any dips we do get. So in the value and core components of the market, if there's any names you like and they have pulled back this week, take the opportunity to buy the dip, because if you look at the longer term trend, things are looking very, very good. But let's actually talk about some market movers. And Ulta Beauty today was up 9%. It beat on the top line, beat on the bottom line, raised its forecast. The consumer looking strong, opening stores. You love to see it. Retail making a comeback. And guys, the consumer looking very, very strong, particularly in the white girl consumer. And it wasn't just Ulta Beauty. Lululemon too, beat on the top line, beat on the bottom line, raised full year revenue guidance. International growing too. That's very interesting. And the consumer looking stronger than ever. Meta shares were up 2.46% following the US appeals court decision that upheld a law banning TikTok from operating in the US under Chinese ownership, and Palantir up 6% after signing a deal with Booz Allen Hamilton. The stock so far this year is up 300%, super high valuation, absolutely crazy. But here's a live look at Palantir's shorts. They're absolutely getting hammered. But let's actually talk about some other market moving events this week. Let's actually talk about the jobs report, guys. The NFP report dropped and November jobs added 227,000 versus the 200,000 expectation. So we did beat, as you can see right here. This is the actual, this is the consensus, and we did see the prior month revised up by 3x. So we did have 12,000 before, now at 36,000. However, the unemployment rate did rise ever so slightly. Previously, it was 4.1%. However, the consensus was for a 4.2% unemployment rate. So that's why the market wasn't too spooked. So I guess mixed economic data, and the reason why the unemployment rate rose was actually because this number wasn't revised as much as previously thought. Something else, guys, this is not actually the unemployment rate. The actual unemployment rate is 4.246%. This is just the rounded figure. So, however, there were some positives out of this job report. Besides the nominal number increasing more than expected, we also saw average hourly earnings increase more than expected. This doesn't help the inflation picture. However, this just means that the consumer is hanging in there, and we probably are seeing that in some of the stocks. Look at Ulta, look at Lululemon, the consumer gaining buying power as inflation continues to decelerate. We also saw your average hourly earnings year over year 4%. Guys, the PCE rate, right, is 2.3%. So the consumer gaining a ton of pricing power. The consensus was for 3.9%. The labor force participation came in slightly below expectations, and we actually did see a pretty big beat in Michigan consumer sentiment that did help stocks overall. We'll see how this pans out with regards to inflation. And today's labor market report is likely to keep the Federal Reserve on track to cut interest rates by another 0.25 percentage point later this month. Traders boosted the odds of that meeting to a 90% chance of a rate cut following the release of this labor report. And pretty much, I think this increased the overall conviction that we probably will get a rate cut in December before we actually see a long pause. So long story short, expect a rate cut and a 4% Fed funds in the month of December. Now let's hop on to the charts, guys. And I quickly want to talk about the week we've just had, the best performing sectors this week, and have a look right here. So the S&P 500 returned 0.9% this week, led by the communication services sector up 2.56%, technology up 3%, and the discretionary space led by Tesla and Amazon up 4% after it gained 10% last week. Absolutely nuts. So all in all, a great week for the S&P 500 and the tech mega cap names. However, every other sector lost this week, energy being the worst, down 4.7%, staples down 0.96%, and then we saw financials, healthcare, industrials, real estate, materials, utilities, all in between that. So all in all, an ugly week for the broad market, great week for tech, and this feels exactly like 2023. This was the trade in 2023. It was the Magnificent Seven gaining, the rest of the market falling, the S&P 500 up. However, this is just 1 week. If you actually look at the last month and the month of November, we actually see the broader market outperforming these guys. So a little bit of a catch-up trade happening here. Nothing to be concerned about. What we're seeing is just simply healthy, normal market momentum. And it was a pretty good day for equity markets. The S&P 500 up 0.25%, the Nasdaq up 0.92%. The IWM did gain today. The RSP was kind of flat. We were down on the day, but up the same amount in the after hours. And all in all, guys, we're seeing some mixed price action in the after hours, but a fairly bullish day for equities in aggregate, led by the mega caps. But you can't deny the fact that a gain is a gain, and you take every gain you can in the market because it's very hard to make money in the market. Looking at what else happened, we saw the 2-year, 10-year, and 30-year yield fall. The dollar gained ever so slightly. Bonds gained as a result. Gold was flat, silver was down, crude was down, and the S&P 500 continues its new all-time highs. We had a wick high and a closing all-time high, another record for the S&P 500. Looking at the weekly chart, because it just closed, that's a weekly all-time high. Very bullish chart here, higher highs, higher lows, and that's a bullish weekly candle closing at the top of the week. Probably signals more upside into next week. And if we actually have a look at the daily chart, yes, we did see a little bit of selling, but inconsequential really when you have a bullish day led by the mega caps. And we probably do see a little bit more upside into the week. Maybe we can see some gains into the early part of the week, and then maybe a pullback once we get to the core resistance, maybe to the gamma flip. That is what I'm looking at next week for these mega cap names. Similar to the Nasdaq 100, we probably do see a little bit of upside, but that is a very, very bullish candle. You don't want to fight that. And then looking at the weekly, super bullish, right? We're pretty much at the top end of the range. We probably eke out a gain or two at the start of next week, and then we probably pull back. And that probably will coincide with stuff like the IWM or the RTY, probably making a bounce back next week. We saw like pretty relentless selling in a lot of the cyclical names, the broader market here today. Look at the IWM, pretty much just sold off for most of this week. Same thing here with the RSP, sold off for most of the week, whereas the S&P 500 and the Nasdaq 100 actually like gained this week. So we probably see that reversion next week where the RSP probably will outperform the S&P 500, but probably closer towards the middle, towards the end of the week, not necessarily at the start of the week. And that same goes for the RTY. So that's what I'm thinking is going to happen next week. We see a little bit of outperformance in the Russell 2000 from about mid-Tuesday, maybe Wednesday into the end of the week, especially if we get the data we're expecting, the inflation data, as well as the earnings data we do have a couple of big names reporting: Costco, Adobe, AVG or Broadcom, and that certainly can bring some volatility. Nonetheless, when you actually look at the Russell 2000, we're at the gamma flip zone right here. Normally that is your indicator to buy, aiming for the core resistance. If we actually have a look at the sell-off, it's very, very ordinary, nothing crazy. It's definitely not this, right? This is just like a typical normal sell-off. You see that we're going to make a higher high, so find some consolidation here early next week and then move higher into the core resistance. That would be the golden play for the IWM, maybe breaking these 52-week highs, breaking all-time highs as well. In the S&P 500, we'll probably just eke out a couple more gains, consolidate here, and then have a little bit of a pullback, forming a higher low above this low right here, and then continue the move into the end of December, into the new year. So that's what I'm expecting. A little bit of weakness in the mega caps, maybe strength in the broader market. But all in all, you don't really want to fight the trend. I'm not getting bearish. I'm just saying what's going to happen in the week ahead. That's what I believe is going to happen. But you really want to remain constructively bullish, because these seasonal trends for the month of December are in favor of the bulls, particularly from next week onwards. And also with the fact that we probably are going to get a rate cut. Capital as a whole is getting cheaper. The Fed is on the side of the bulls. A Fed put, Trump put is really going to keep lifting stocks and supporting the overall valuations in this market. Looking at a couple of other proxies for risk, Bitcoin, very volatile. Look at this candle. That is absolutely crazy, but you can't deny the fact that it's risk on, and that bodes really, really well for all risk assets, including equities. The dollar continues to gain strength as yields fall. That's not really good for companies with international revenues, which is why it's really weird that the mega caps actually did gain this week over the broader market. Nonetheless, falling yields should continue to support the overall equity complex, and what the dollar does, it's anybody's guess at this point. Looking at gold, has suddenly come under pressure after a stellar rally, so I think we're probably just going to see a bit of consolidation before making the next move onward and upward. I do have a $3,000 gold target for 2025, and that would represent anywhere from 12 to 15% upside from the 2600 area. And then looking at silver, very much the same like gold. We're just consolidating, getting ready for the new year. But guys, you do have to understand that rate cuts are very, very bullish for precious metal, but the path isn't just straight up like it has been with Bitcoin. When it comes to these type of assets, you know, there is consolidation periods that you do have to go through before making the next move higher. All in all, this is a market where you want to be risk focused, and that is you want to be in equities, particularly US equities, some of these great names in the Nasdaq 100, the S&P 500. And if you want to hold these smaller cap names, hold the broad based indices. But guys, any dip we do get, buy the dip, don't trip. We will go higher into the end of December. Material downside is only going to come middle of January into the new year. So don't fight the trend. Don't try and beat them. Join them. And looking at sentiment, this is CNN's Fear and Greed Index, and we saw a little bit of a downtick here in sentiment from about the middle of this greed zone to right on the edge of greed and neutral. Very interesting to see. That probably has to do with some of the breadth dynamics we've seen in the market as of late. We've seen breadth fade, particularly this week and in the last 5 trading days. And this is a very noisy indicator. It's highly dependent on breadth. That's why we've seen a little bit of a pullback in sentiment. However, greed is still driving the market. And when we look at other sentiment indicators, things are still looking very euphoric. Looking at leverage single stock exposure soaring up 10x here into the month of November. So people really putting on leverage. They're liking what they're seeing in the equity markets right now. And this is often a sign of peak euphoria. Now, equity markets don't actually necessarily top when this happens. The top normally occurs about 6 to 8 weeks later. And whether it's a larger, bigger top or a smaller, healthy pullback, the garden variety kind, we normally see these events precede that. So in early 2025, do be aware of the risks that are in this market. Leverage is being used, and that does create volatility. Strategists are also very positive. We can see here the average year-end forecast right now for Wall Street is plus 10.59% from the current price. The assumed year-end estimate is about 6,600. At the start of 2025, it was 1.36%. So strategists are bullish, sentiment is bullish, Wall Street is bullish, Main Street is bullish. But there are risks that we do need to be aware of, especially when we have made a significant amount of record highs like we have in 2024, 56 so far. The average returns tend to be quite lackluster, -3% on average, -6.2% median. However, do take this with a grain of salt. We only have 6 data points to choose from. You need about 30 data points for any data set to be statistically significant. However, it's still data we want to look at, and the S&P 500 tends to have poor performance after years with 50 record highs. The only 2 exceptions, 1964 and 1995. Take it as you will. However, if you want to generate alpha, I definitely suggest looking at the Russell 2000, because generally after the Russell 2000 has a month where it gains 10%, we normally see outsized returns of 1 month, 6 months, and 12 months thereafter. You can see November 2024, the Russell was up 10.8%. The average return 6 months later, 11.4%, median 11.3, 12 months later, 15.7 and 14.8 average and median returns. 18 out of 20 times the Russell 2000 was higher, 14 out of 19 times, 12 months later, the Russell 2000 was higher. So take that as you will. The average up year, however, 25% in the Russell 2000, 12 months later. So guys, small caps, mid caps, the equal weight, that's the place you want to be, because history tells us that we should see outperformance in the Russell 2000 and maybe some bumpy action ahead here in the S&P 500. But what's really holding this entire market together is definitely the macro. And looking at the overall economy, things continue to point to a robust environment. The Fed's GDP now ticked up again from 3.2% yesterday to 3.3%, smashing the blue chip consensus, meaning we are seeing upside surprises to economic growth. Inflation, headline inflation and headline PCE currently also shows no signs of concern, running at an annualized pace of 2.2% over the last 3 months and 2.3% over the last year. And as long as energy and food prices remain muted, headline inflation should be contained, again, barring any surprises. Now, inflation data could get hairy going forward thanks to lagged housing inflation and stock prices pushing up financial services inflation. This raises the risk of an extended Fed pause, and that's a big risk that's not discounted right now. That's a Fed policy error risk. We haven't seen that right now. Everybody thinks the Fed is doing a great job. And the biggest risk to the market right now is the Fed making a mistake. If we actually look at this right here, this is a sentiment poll from Warren Pies. He asked, what is the biggest risk to equities in 2025? Inflation reacceleration or economic deterioration? And even though it's just 2 posts and that the votes are quite close together, you can definitely see here that inflation reacceleration is not the base case. It's actually economic deterioration. And this right here is where the risk of a Fed policy error exists. So that is one major risk I see in 2025, as well as where sentiment is right now. Nonetheless, I'm not saying you guys should be seller or get overly bearish. I'm just saying that that could cause very near-term volatility at the start of the year. And that's what I'm thinking. I'm thinking, circa mid-Jan to that March area, we could definitely see a very material pullback. Nothing to be concerned about. I think the bull market will continue into 2025. I'm just saying that these shocks to the market could rear its head in the first and second quarter of 2025. Nonetheless, the overall macro environment looks really good. The labor market looks good. Inflation looks really good. The consumer hanging in there. We got reports from Ulta Beauty and Lululemon yesterday. It seems like the consumer is really, really strong in that area, particularly the middle class. And the only risk to this market could actually be inflation. Now, next week, we do actually get the CPI numbers, headline and core, on Wednesday. The market's expectation year over year is for 3.3% for the core version, 2.7% for the headline. And then we get PPI on Thursday. And then with regards to earnings, we also have a fairly big week of earnings. Next week, we have ABGO Broadcom. They're reporting earnings. That's going to be huge for the semi space. Oracle as well for the software names, as well as technology, especially the cloud names. Costco's reporting, Adobe too, AutoZone, Lennar, a huge home builder, Ferguson Enterprises, MongoDB, Casey's General, Toll Brothers, another home builder. Two of the biggest home builders actually reporting this week. We also have GameStop, Sienna Corporation, a lot of mid caps and small caps reporting next week. But the bigger names, ABGO, Oracle, Costco, Adobe, these 4 names are really going to move the market, particularly in the discretionary space for Costco, and then the software space for Adobe, Oracle, and ABGO, as well as the technology. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.